Hi, my name is Jordan Wilson. I'd like to take a few minutes today just to sum up our conversations on lump sum investing versus dollar cost averaging. Now, when we looked at lump sum investing, I think it's clear that over long time period, lump sum is the better way to invest, because the sooner you put your money in and the longer you leave it, the greater the appreciation. And that's regardless of asset class. So why should we consider dollar cost averaging? Now, again, if we look at assets, and if we look at the Ibbotson SBBI stock, bond, bills, and inflation chart, from 1926 to 2017, we see that long-term steady appreciation of assets. And we also see that the greater the risk of an asset, so bonds being more risky than cash, equities being more risky than bonds, the wider the disparity in the returns over time. And that's just simply the risk-return relationship. So over time, lump sum is preferable. The other advantage of lump sum investing is if you can market time. Because as we see from the graph, and we'll see from a couple of other graphs, that markets just do not go in a straight line upwards. There's lots of volatility along the way. If you can time selling into the market highs and buying into the market lows, that can really accelerate your returns. The third advantage of lump sum investing over dollar cost averaging is that you should have lower fees. And that makes sense, because if I'm going to invest $12,000 on day one, with most online brokerage accounts today, you'll be charged a single transaction fee for that asset, so $9.99 per trade. Whereas if you're dollar cost averaging and you're spreading that $12,000 monthly over 1 year, you're going to still incur $9.99 per trade, but now it's multiplied by 12. And over the life of your investing, those relatively minor discrepancies in transaction costs do add up. So that's kind of the case for lump sum investing. Now, why would we then consider dollar cost averaging? Because, to be quite frank, that's what I tend to advocate for clients and investors in general. The first item to look at is market volatility. And I just said that could be an advantage of lump sum investing. If you're an expert at timing market highs and lows and jumping in and out at the right time, that's an advantage of lump sum. However, the reality is that even professional investors, professional money managers, do a relatively poor job of timing markets. And we saw that in our discussion on alpha, the inability to outperform the benchmarks. So we see that on a consistent basis over time, professional money managers are not able to outperform their benchmarks. They're not able to add value against the fees they charge. So if they can't time the markets, can you? And that, to me, is the question. So again, if we look at a chart on the Dow Jones Industrial Average between 1915 and 2020, we see that, yes, if you bought in early, it does appreciate. But there's lots of bumps and ups and downs along the way. And if we look even closer, just at the last roughly 30 years, 1990 to 2020, and we drill down a little bit farther, we see significant volatility. Now, if you invested a lump sum in 1990 and you had a 30-year time horizon, you did very well. Much better than if you dollar cost averaged. However, if you were that same person that invested everything instead of 1990 at 2000, much less of return, because there was the ups and downs and the sort of the stagflation type activities during the 2000s. So that's an issue. And I think that when you dollar cost average, you're putting in a set amount each period, say monthly. And when the markets are up, you're buying relatively less shares, less units. And when the market is down, that same dollar value gets you relatively more units. So over time, you're spreading out your pricing, which can help out in the long run. Another potential advantage to me of dollar cost averaging is the smaller investor. And by small, what I mean is you don't have excess cash just sitting around in your bank account waiting to invest. And that tends to be the premise in the studies comparing lump sum to dollar cost averaging, is that you're able to make that initial purchase for the lump sum on day one. So my earlier example, if you have $12,000 to invest, you have that money sitting there ready to invest on January 1st. Whereas on a dollar cost average, you'd have to spread that out $1,000 per month until the end of the year. Now, how many people listening to this actually have the 12 grand just sitting there and someone says, oh, it's time to buy Tesla, it's time to buy Facebook, and you put the money in? The reality for most of us is that we have to scrimp and save to invest. So even though lump sum may be better, the reality for your smaller investor especially is they don't have the money to lump sum invest up front. And if you have to save for a year to make that lump sum investing, then you've lost a year or 6 months or whatever in that comparison. So it becomes more apples and oranges than apples and apples. So that's why I think dollar cost averaging for most investors, because I think most investors are smaller in size. And especially if you look at RRSP season in Canada, where there's a huge rush in February before the cutoff date for RRSP contributions arrives. They're taking out short-term loans from their bank to make those RRSP deductions or contributions. So that's kind of the small investor aspect. The next side, I think, is consistency. I think that dollar cost averaging promotes consistency and discipline with the investor. By consistency, what I mean is that if you set aside $100, $200, $500 per month to invest, it becomes a consistent process. You continually set aside, let's say, relatively small amounts, and you're paying yourself as if it was an ongoing expense, such as your cell phone bill, your internet bill, your cable bill, those sort of things. And over time, hopefully you reprioritize and you end up almost forgetting about it I mean, how many people think about their cell phone bill in a month? Whereas if you lump sum invest, I think it takes, at least psychologically, a bigger chunk out of you to sort of say, oh, I've got to come up with 12 grand to invest. And I think that's the same again with the discipline side, is that if you set up an investor profile, your target asset allocation, and then a plan of attack, it's probably easier to adhere to that if you invest in relatively small amounts on a periodic and consistent basis. Then again, if you suddenly say, okay, I've got to come up with 12 grand to implement this. There's also what I've called before, kind of the January in Western Canada effect. And we see that with a lot of investors in their tax-free savings accounts, TFSAs, where it's minus 40, minus 50 on the prairies, and there's a seat sale to Honolulu. And suddenly, okay, I know I should invest, but I need to get out of here. Whereas again, if you're doing on a consistent basis in smaller amounts, that's really not the issue. It's, I've got $200 to invest. I need $4,000 to go to Waikiki Beach. As opposed to, I've got 12 grand in the bank to invest, but I'll just take 4 grand and fly away for 2 weeks. Again, on the discipline side, I'm a big believer in behavioral finance. So that's key, I think, to investing success is the discipline side. If you invest more on a lump sum basis, you can tend to be more emotional. You have the fear of missing out. The markets are rising. All my friends are jumping in. I'd better jump in. And usually that's probably the wrong time to be buying, because what you'll often see is investment bubbles as people overreach. And then on the downside, there's the actual fear to invest itself. The markets are crashing. I don't want to buy. And then by the time it turns around, you're probably too late to take advantage, or you see it, maybe it'll be a second correction. I'm concerned. So that's kind of the emotional side. Whereas again, if you're investing $200 per month, $500 per month, it's coming out of your bank account June 15th, July 15th, August 15th, and being invested. You're not worried about the markets are overheated, the markets are going to continue crashing. And again, under dollar cost averaging, if you're investing in a fund that's trading at $100 and you're putting in 1,000, you get 10 units. But if the markets are overheating and that fund has gone up to $200, you're only going to be able to buy 5 units at that $1,000. And if the markets have crashed down to, say, 50, that $1,000 will get you significantly more units. So again, that's sort of, you're buying on the lows, you're buying less on the highs, you're smoothing out your cost base. So I think the discipline and the consistency are two big factors for investors that are worth considering. Another area I think dollar cost averaging is good is on diversification. Now, yes, I will say up front that you can lump sum invest into diversified investment products, and most investors should. But I think a lot of people that lump sum, they tend to more pick individual stocks. So you may not get that diversification. Or you may not even be able to buy certain stocks. For example, Amazon trading over $3,000 a share. Google over $2,000. If I want to invest $2,000, I can't even buy one share of Amazon or Google. And even if I have that $12,000 to invest in a lump sum, what can I buy? I can buy one share of Amazon, one share of Google, maybe 4 shares of Facebook, a few shares of Apple. Is that creating a well-diversified portfolio? Not really. So I think that, again, the dollar cost averaging lends itself to the diversification. And then when you factor in that most of the mutual funds out there, they tailor to people the dollar cost average. And you end up with maybe an initial purchase when you buy into a fund, you have to spend a little bit more. So maybe $500 or $1,000 or even $2,000 for that initial purchase of the fund. But then on an ongoing basis, they'll set up direct debits from your checking account. And many funds will allow additional purchases for $50, $100. Now, how can you buy Amazon or Google by investing $50 or $100 at a time? You just can't. So that's kind of the beauty of the diversification and how fund companies especially have been set up to deal with those sort of folks. The other thing I think that's important with lump sum or dollar cost averaging is when you purchase something, you usually want to tick off the DRIP box when you buy, and that's the dividend reinvestment plan. And all that does is, if you don't need the cash flow, so if you're not, say, a retiree that's requiring positive net cash flow, instead of receiving cash when there's a distribution from a fund or a dividend from a company, the money just gets rolled over into additional shares or units. And there's no transaction costs, so that's a good way to help you compound return. And the final thing I'd probably want to say is you want to invest in quality. And again, that's something I think that you can do lump sum, but it's geared towards dollar cost averaging. And I think that quality can be an elusive concept for people. And again, that goes back to the inability of professional money managers to consistently outperform their benchmarks. If it was easy to pick superior investments, everyone would beat their benchmarks. And by that I mean, look at the S&P 500 or the TSX 300 or the NASDAQ 100. Now, if I have the S&P 500 as my benchmark, and I actually know anything about investing, instead of owning 500 companies, I say, 100 of these are just dogs. They're off the radar. I'm not going to invest. They're just going to drag down my overall return. And there's 100 stocks out there that are clearly A+ as far as my rating goes. So instead of buying the dogs, I'm going to double up or triple up on the superstar companies. And of course, I'll beat the benchmark. So why is it that the professionals don't outperform their benchmarks? It's not as easy consistently picking the stronger individual investments in an index. So I think that, again, the dollar cost averaging tends to promote itself more to ETFs, to index low-cost mutual funds, where you're building a diversified portfolio and you're just trying to match the market return. if I cannot, as a professional, accurately time the market, and I'm not able to consistently pick the winners and losers, why not just buy the market? And again, there's so many products out there, so many index funds that allow you to do that on a low-cost basis. And of course, I think the final comment is that quality can change over time. And so you need to still periodically review your portfolio and rebalance if necessary. And I think that's a plus as well with investing in index funds, because what you find is that even if I maintain a buy and hold mentality, so I buy the S&P 500 and I hold it forever, or if I buy the Dow Jones 30, hold it forever. Yes, I'm holding the index and I'm not trading that, but the individual components will change over time. If we look at the Dow, in 1999, I mean, classic companies like Goodyear Tire, Sears Roebuck, Chevron, they left. They didn't have what it takes as far as the index criteria to remain listed as one of the top 30 companies. So who comes in then? Who's moving up through the pack? In 99, we saw Microsoft, Intel, SBC, Home Depot. They come in while the old lions depart. Same in 2013, we see Alcoa, Bank America, Hewlett Packard leave the index. In their place comes Nike, Goldman Sachs, Visa. 2015, AT&T, which had been on the index since 1916. They get the punt. In comes some fruit company named Apple. I think that's a good example of what I said earlier, though, is that with Apple, you would have been much better if you'd identified it as a great investment before 2015. So that's sort of the downside of index investing, is that you only acquire these companies once they hit the thresholds for inclusion on a index. And Apple, you would have been better off buying much sooner. So that's kind of a look at you're owning a index, but the index holdings themselves tend to move around. And that's, again, a good way to keep the consistency, the discipline, the quality, because you're not having to juggle things on your own. You're just buying the one index. And the index criteria, the reasons that it is one of the top 30 companies in the US, that's what juggles things coming in, things going out. So that's a quick overview on dollar cost averaging versus lump sum. And for much more detail, obviously, if you look at a few previous episodes, I drill down into these subjects in much more detail. But I think over time, lump sum will win out as far as performance, at least according to the studies. Just beware that those studies will assume that you bought the lump sum on day one, which most people don't have the cash sitting around. And I think that dollar cost averaging has some different benefits. And I think it's important for investors to develop better investing habits. And dollar cost averaging does promote consistency, discipline, diversification, quality of assets. So I think that trade-off between perhaps the true long-term performance of lump sum versus the other benefits that dollar cost averaging brings is something that's worth considering and implementing in your own investing plans. Next up, we'll start looking at another age-old investing debate: the buy and hold versus more actively trading. Which is better? So thanks for listening to this summation, and we'll be back next week with the buy and hold debate.